China's housing market used to be the go-to place for growth, luring in millions of investors and home buyers with the promise of big returns. But now that booming market is in serious trouble with a sharp downturn marking the end of its golden era. A major liquidity crunch hit private developers hard, like a tsunami, and the massive Evergrande Group is right at the center of this mess. Evergrande, founded in 1996, soared to become the world's most valuable real estate company by 2018, only to face a dramatic collapse just 3 years later in 2021. This crash kicked off a wider real estate crisis in China, shaking up consumer confidence and investor sentiment. The Western media is, as usual, widely covering this topic, and the China collapse theory has gained traction once again. But is it true that China's property market is collapsing? Can China's real estate industry recover and see property prices rebound? Well, in this video, we will talk about that, but before you continue watching, please subscribe to our channel so you can keep receiving more interesting videos just like this one. Now, let's talk about China's property market and the country's economy. China's real estate, what went wrong? In China, real estate is more than just an economic asset. It's a cultural cornerstone. The Chinese traditionally prefer investing in property because it's tangible and likely to increase in value. A home isn't just a place to live. It's a symbol of prosperity and an essential part of marriage, deeply embedded in society. Historically, owning land meant wealth and status in China, and that sentiment still holds strong today. China's real estate sector, once a pillar of economic stability and growth, is now facing a crisis of unprecedented scale. The industry, which contributes nearly a third of the nation's GDP, is witnessing the collapse of its leading giants, Evergrande and Country Garden, amidst a broader market downturn. Several factors have led to the downturn in China's housing market. Firstly, potential home buyers are increasingly worried about job security and future earnings. A recent survey shows a sharp decline in the intent to purchase homes in 2024. Secondly, the market is filled with caution because many real estate developers are failing to deliver projects on time, causing instability. This has severely damaged consumer confidence in the sector. Lastly, China's demographic challenges, especially its aging population, are naturally reducing the demand for new housing. These factors have combined to create a perfect storm, leading to a crisis in an industry that once seemed invincible. With property values and sales plummeting, the real estate sector's problems have become a major drag on the broader economy, making urgent and effective policy responses necessary. Beijing has stepped in to boost the property market. Recently, China's government has announced a series of measures to boost the housing market. These measures include reducing down payment requirements and removing the floor for mortgage rates to encourage buyers to return to the market. Local governments can instruct state-owned firms to purchase completed unsold apartments from property developers and convert them into social housing. China's central bank is setting up a 300 billion yuan re-lending facility, which could result in 500 billion yuan worth of commercial bank financing for state-owned enterprises' purchases, equivalent to 0.4% of the country's GDP. Local governments can also repurchase idle land from developers, improving their cash flows. Since 2022, there have been repeated cuts to mortgage rates and down payment requirements, along with waves of loosening purchase restrictions. Authorities have also approved 935 billion yuan in commercial bank lending for the completion of projects by developers. The central bank has a 100 billion yuan financing program for 8 pilot cities to buy unsold homes for subsidized rental housing and a 500 billion yuan supplementary lending scheme for other real estate developments in the country. This is the first nationwide government purchase program for the property market since the sector's bubble burst in 2021. If households and banks feel that the government is ready to be the buyer of last resort, home buying confidence may pick up and funding channels might unclog. Why China's economy isn't collapsing. The Chinese economy has faced serious challenges since 2022, especially in the real estate sector. This sector, directly accounting for 11% of GDP and indirectly about 25%, has significantly underperformed compared to other parts of the economy. In fact, since 2022, the real estate sector has negatively impacted China's overall economic growth, contributing to the recent economic slowdown. Despite the real estate sector's drag on GDP, China still managed to outperform expectations and recorded a 5.2% growth rate in 2023. How is this possible? First, while the real estate sector is a problem, other sectors are growing enough to offset the negative impact. For example, in 2022, the green economy and the digital economy added 4.7% to China's growth rate, more than compensating for the 3.7% negative contribution from real estate. China is a global leader in industries driving the fourth industrial revolution, such as green energy, digitalization, industrial robots, and artificial intelligence. The country dominates in solar panel production, drones, mobile phone production, lithium batteries, wind power equipment, and industrial robots. For instance, in lithium batteries, essential for electric vehicles, mobile phones, and other technologies, China went from 0% of the global market in 2005 to 63% today. Similar growth has been seen in wind power and industrial robot installation. Second, China has significant policy space to adjust and boost its real estate sector. Interest rates in China are relatively high, with lending rates around 4%. This means the real interest rate is still higher than in the United States and much higher than in Europe or Japan. China's cash reserve ratio, the percentage of deposits commercial banks must keep with the central bank, is about 10% for large banks, compared to 0 to 1% in Western countries. This gives China room to ease monetary policy by cutting interest rates or reserve ratio, or both, which other major economies can't do as easily. The Chinese government has already taken steps to boost the real estate sector. These measures include easing restrictions for first-time home buyers, lowering down payment thresholds, and reducing minimum mortgage rates. Authorities have also broadened the qualifications for first-time buyer status, increasing the pool of potential homeowners. In a more direct intervention, local governments plan to purchase unsold homes from distressed developers and convert them into affordable housing. This effort is supported by state-owned enterprises and financed by state banks, reflecting a coordinated approach to tackle the housing inventory glut. Additionally, the central bank has cut bank reserves, signaling a commitment to inject liquidity into the financial system. These policy measures show Beijing's determination to prevent the real estate crisis from further undermining consumer confidence and economic stability. In conclusion, China is facing some economic challenges. Business and consumer confidence are currently low, and it will take a couple of years of stable and supportive policies for the private sector to fully regain confidence. The economy is not performing at its full potential. However, China's economic fundamentals are strong. The government has plenty of room to implement policies to address the current slowdown, and its industrial development is setting it up well for the future. Despite the skeptics, China's growth is likely to continue for the foreseeable future. Do you agree with our analysis? Share your thoughts and comments below this video. If you like what you have watched, hit the like button to show your support. More importantly, subscribe to our channel so that you will continue to receive interesting videos just like this one